And I was talking actually to the Gnome of Zurich earlier this morning about this, and I said, well, the banks are still involved in this indirectly. And he said, well, what do you do when you can't like shoot your neighbor, right? You can't go there and shoot him. Well, you hire a hitman. And this is just an analogy, of course. So the regulated depository banking institutions, well, they're still involved in this risky lending, but they hire the shadow banking system. So I thought that was a good analogy from the Gnome of Zurich. Tuesday, October 21st, 2025, Maneco 64, home of alternative economics and contrarian views. Well, today we're going to look at what could be a black swan for the whole financial system. It could be what triggers the next crisis and a potential big market, stock market correction, and that is shadow banking. We saw last week that the Fed had to open, let financial institutions use their repo facility because the private market repo is kind of clogged up, or maybe people are losing faith and confidence in financial institutions. And the shadow banking system is just a system that's outside regulated depository or banking institutions, and it has evolved since the crisis of '08, because with the banking collapse of '08, there's a lot of new regulation that came out through Congress and other institutions that banks couldn't do things that they used to do anymore. So institutions like private equity, private credit, other non-depository institutions like pension funds or family offices, they've kind of made up for it, or they're doing what the banks used to do. But what we're learning now is that the banks are heavily involved because they have exposure to the shadow banking system as well, because ultimately they're the ones who provide the credit for the shadow banking system that provides credit to to companies, right, and to businesses in the private sector, non-public market. And I think it's something that we need to keep an eye on, and even the venerable JP Morgan Chase is warning about it, and we're going to look into that today. But before we do, I just wanted to give a shout out to one of our affiliates, Dirty Man Safe. So Dirty Man Safe is a really great way to hide, secure, and retrieve your valuables with ease. Yeah, you can put whatever you want in there, but I would say things like gold coins, bars, jewelry, documents, and anything else that's valuable for you. They do a small, normal size one and a bigger one. And if you want to find out more about Dirty Man Safe, there's a link below in the description, and you get 10% off if you use my link. So back to shadow banking. I've been covering this for the last month or so. Back on September 25th, I did a video entitled "The Shadow Banking System is So Fragile That Even the ECB is Concerned." And then 4 days later, I did another one, First Brand Collapses, Fed Could Be Forced to Restart QE. And we also saw Tricolor collapse. And we're going to go through now this JP Morgan article that came out yesterday. So it says JP Morgan warns First Brand's fallout driving up banks' funding costs. Yeah, and we saw last week that the smaller regional banks, they had a really bad week because they don't have the clout of Wall Street, New York center banks. So they usually get involved with riskier business, and they probably have a lot of exposure to some of this shadow banking sector. And it says here, concerns mount about hidden exposure to private capital firms and hedge funds in wake of credit market wobbles. So yeah, I forgot to say hedge funds are part of this shadow banking as well. And they're not regulated like depository institutions, so it's very opaque. And it's funny because back in 07, 08, 09, one of the big problems with that crisis is that a lot of the leverage and the speculation occurred in the over-the-counter derivatives market, which is really opaque as well. It's not a public market where you get information regularly. The prices that they give you are quite subjective. So the real value is not really well known, and when problems arise, everything hits the proverbial hits the fan, right? Don't want to say what hits the fan, but anyway, JP Morgan Chase has said that credit worries from the First Brands and Tricolor bankruptcies, and I covered those two in those videos back in September, have driven up banks' funding costs, with investors concerned about lenders' hidden exposure to private capital firms and hedge funds. The JP Morgan analysts made Monday's comments about the implied cost of equity after last week's sell-off of bank stocks, which was sparked by disclosures by two U.S. regional lenders that they were exposed to alleged fraud by borrowers. I think that was Zion's Bank, and is it Western Alliance? I'm not sure that's right, but two banks anyway. The high-profile collapses of car part maker First Brands Group and subprime auto lender Tricolor Holdings within weeks of each other have highlighted the complex and often opaque arrangements between banks and non-depository financial institutions. So this is supposed to keep the banks away from this kind of lending, but it looks like the banks are actually a bridge for the shadow banking system to get the funding so they can lend it to riskier companies in the non-public market. And it's really strange. And I was talking actually to the Gnome of Zurich earlier this morning about this. And I said, well, the banks are still involved in this indirectly. And he said, well, what do you do when you can't shoot your neighbor, right? You can't go there and shoot him. Well, you hire a hitman. And this is just an analogy, of course. So the regulated depository banking institutions, well, they're still involved in this risky lending, but they hire the shadow banking system. So I thought that was a good analogy from the Gnome of Zurich. Anyway, it says, JP Morgan said banks' lack of transparency about lending to such so-called NDFIs, non-depository financial institutions. They love their acronyms, right? A broad category that includes private equity groups, private credit firms, and hedge funds, was pushing investors' demands to demand higher compensation for owning their shares. The recent global banks sell-off was triggered by poor risk management, in our view, as shown by First Brand's supply chain exposures, but more importantly, very poor disclosure in relation to NDFIs globally across the banking system, JP Morgan analysts said in the note to investors. The note was titled, NDFI Exposure Analysis, Lack of Disclosure Drives Higher Implied Cost of Equity. I spoke about the repo market last week, that for the first time since the COVID 19 event. The Wall Street has, or financial institutions have had to use the Fed's repo facility. It was only about 18 billion, and that's a bad sign. It means that the private repo market, where the Fed is involved, there might be some cracks there. Yes, it could be because we're near to the end of the year and the funding is more difficult and more expensive. But I think we really need to keep an eye on this. And in terms of repo and QE, I saw a post the other day, and I'll try to find it here for you. And it was from Eric Young, who I've interviewed here several times. And he's quoted Nick Timiraos, who's the Fed whisperer, right, who works for the Wall Street Journal. And he says, and wait until they not only end QT, but then also buy bill securities for reserve management purposes. And the translation is that all that will mean is more QE, yield curve control, and currency printing. And I think what's happening in this not subprime, but in this shadow banking world, and the fact that JP Morgan is warning about the credit, faith and confidence in this credit system, it could trigger another round of QE from the Fed to keep things going. Yes, they're still doing QT, but I think they're going to stop that fairly quickly. They might even announce that next week at their FOMC meeting, in my opinion, because things are getting pretty interesting, I would say. And of course, looking at the charts, S&P and NASDAQ, they're near all-time highs. They look really bullish. It looks like everything is fine. But one thing I would say is that prior to the crash in 2020, it was the same kind of situation. The markets were near all-time highs. Everything looked really bullish. And all of a sudden, bang, everything drops. Same thing in 07, 08. Markets were doing really well, all-time highs, and then they just keeled over. The problems that eventually led to the Lehman collapse in 08, they were coming out, but the market was just ignoring it, just like it's ignoring now this shadow banking, these shadow banking problems. So yeah, I would keep an eye on this. I think it's quite serious, and I think it could be what triggers the next big crisis. There's also another big elephant in the China shop that I want to talk about, but we're going to do that another day, hopefully, with Francis Hunt, the market sniper. And that's the fact that the little island of Cayman in the Caribbean is holding $1.4 trillion of treasuries through derivatives, basis trade. So it's not just shadow banking, but the treasury market is a potential bubble that could burst. So we're going to look at that. So let's quickly look at the markets, where they are this morning. It's just gone past 8 a.m. London time. Gold rebounded. Gold made up all its losses from Friday and a little more. I followed it late yesterday, London time, and we made an all-time high, albeit by just $1, and then it turned. And some people might say, well, that's a double top, and it could be in the short term, but I was speaking to the Gnome of Zurich, and he does a lot of Elliott wave and analysis, and he told me, actually, before the market went up, that he was expecting another leg down, and he said if we do make a new high tonight, it won't be significant and the market will turn, and he's been completely right. So what he's trying to say is that it still looks really bullish. And of course, it's getting more volatile. But anyway, we are above 4,300, which if you had told me a month ago we'd be there, I wouldn't be shocked, but it would be a pleasant surprise. Anyway, right now, yeah, we're 43.39, down 17. Low's been 43.16, the high 43.75. The all-time high now in the spot is 43.8150 or thereabouts. Spot silver, yeah, silver has underperformed. It underperformed yesterday and is doing so today. But I think silver still has so much potential. And I'm not giving up on silver, of course, or the silver miners. Well, we're at 51.64, down 70 cents. High's been 52.95, so just goes to show you the volatility. And the low 51.14. Well, the stock market is down across the board. Not significantly, though. It's down about 0.1%. The Dow futures, S&P, and the NASDAQ 100 future. Currencies as well are very quiet. Yeah, and the bond markets, they've kind of rallied of late, but I think gold and silver have rallied much quicker than the bond market, which means that yeah, in real terms, in real money, hasn't really done much. And with a lot of opaque transactions, like I was telling you about the Cayman Islands, I wouldn't want to be involved in treasuries or gilts. Anyway, with that, I'm going to wish you all a very good day. Take care. Bye.